Who else has stuff going on in the
Question
world?
regarding the recent interest rates that we've been experiencing, 8 of them or 9 of them in the past year. I normally suggest seller financing or buy down the interest rates for the seller. What other alternatives are there to combat this increasing interest rates that we are experiencing?
Well, hopefully the Fed is going to, back off. I mean, the last increase was 1/4 point, and I think hopefully they're going to be done for a while. But certainly everything they've done in the last year has been hugely detrimental to small business and small business sales. I mean, it's just killed the little guys, which is kind of right. The big,
That might be the
800-pound gorilla. I guess that's probably the point of a lot of it. But I think there are some banks that are doing fixed rate SBA 7A loans that are doing, fixed rate at like, I need to check, but I was aware of a couple of them here in California that were doing fixed rate around 8%, which was lower than your typical prime plus 2.5 or prime plus 2 3/4.
Right.
So I don't know if I don't know how long they were going to maintain that before they were going to go ahead and, jump back, and they may have already filled their quota with those 8% fixed loans. I'm not really sure, but that's but I would check with, just look for other banks, because I also saw that there were a couple of banks that had been forwarded to me where even when prime was up at 6.5 or so, they were still offering loans right around prime, actually. So some of the banks have different programs where they can keep the rates a little bit lower for a period of time, but I would just try and find as many lenders as possible where you might be able to get lower interest rates for your clients. And then check the terms, because the last thing you want to do is steer somebody into a loan that's going to have a lower interest rate up front, but then going to jump by 3 points 6 months to a year from now, or have some kind of high step ups. And the other thing you have to watch for, I mean, I had a client send me some loan documents he wanted me to review for him. That was on the legal side of the house, because I don't do that as a broker, but as an attorney, I will. So, but and he's not a business broker client. He is strictly a, law practice client, but he was looking at getting a line of credit, and he asked me to review these loan documents for him. And I took a look at him, and literally this loan, the way this loan was written, the interest rate could adjust on it daily. Daily. I was just like, I said, dude, this is not a loan you want to get into, because this thing could be all over the place. So you do have to be careful about what they're selling. And he wasn't out looking for a line of credit. Somebody had approached him and was, hey, cheap money, this, that, and the other thing. And it really wasn't cheap. It started off cheap, but within 6 months it jumped and then adjusted daily after that. So it's like, this is not anything that's going to do you any favors in the future. The other thing about that loan document, it had, even though there was a cap on the credit, on the line of credit, they wanted an unlimited, they wanted liens against all his businesses, cross-collateralized against all his businesses, all his property, and unlimited, guarantees from he and his wife. And I was like, if you're going to sign a loan guarantee, it should not be unlimited under any circumstances. I said, literally what they're doing is setting you up so that they can
take over,
find a reason to default. Okay. Because I mean, the default terms were kind of ridiculous too. It was pretty easy to get somebody to default on that loan. On any default, like even a late payment that's a day late, they could automatically add 5 points to the interest rate. Okay. And then after that, start, between the the default rate, the late fees, whatever penalties and all of that, I mean, you could take $100,000 loan and turn it into 200,000 in no time flat. I mean, it was just ridiculous. So
I have a question, Tanya. Was that wasn't an SBA? That was
no, it wasn't an SBA at all. Mm-mm.
Right. But the SBA does ask for personal guarantees, right?
Yes. Yeah, SBA will require personal guarantees on any owner that owns 20% or more of the business. Okay, so if you have an investor partner that only owns 15%, they're not going to have to sign a personal guarantee. But anybody who owns 20% or more will.
But when you said unlimited personal guarantee, what's the difference between personal guarantee and unlimited? I know what you're saying, but isn't the SBA basically unlimited? I mean, they don't say, well, except for your house, unless you put that in the document, right?
No, but I mean, typically your personal guarantee is going to be the amount of you're guaranteeing a loan or a loan amount. Okay, and so on the guarantee itself, where normally let's say the loan amount is $100,000 and you're personally guaranteeing to repay that $100,000. So in this case, on the guarantee itself, it didn't say the amount of the loan or anything else. It just said it was an unlimited guarantee. And it's just too broad. I mean, it's like giving somebody a blank check. So,
well, collateralization is a big problem for people that don't know what they're doing, right? They're over collateralizing a loan, but it's typical. It's really typical, I think. Banks are asking for whatever they can possibly get, and then they sue the socks off of you. I mean, I had it happen to we bought a business, and I may have mentioned this in another meeting, but it was a trucking company that I owned, and we picked up a company in Arkansas, and there were 4 owners, the father and 3 sons. They all signed on the SBA, and they all lost their houses, every one of them. We walked in there and took over their business for little or nothing, and they walked away with their, basically their children and their wives. They didn't, it was the saddest thing. And I always remember thinking, what could they have done different besides, because it was an SBA loan. It shouldn't have, maybe bankruptcy, I don't know. But the end of the story was that they lost their houses, all of them.
yeah. Well, yeah, I mean, you have to know a lot more of the details to figure out why that happened.
Right. Well, stupidity was certainly one of them, but I just felt it was horrible.
Yeah.
And so I've often been very careful about, guarantees after I saw that, and make sure that these personal guarantees, how broad they are. I mean, it's a personal guarantee. I mean, it's whatever you own. So I guess if a corporation owns it, or if it's some sort of legal, and Tanya, you would know the way to do this, right, properly. But there are ways to get out of certain liabilities, I'm guessing, and I've probably done it myself. But I think that it is a danger. Now, the reason I bring this up is that because I think Michael said, or you did, about owner carry the note, tote the note. It's going to happen more and more. Both these businesses I've talked about, and in fact, the engineering company, they are considering toting. They want to tote the note. Actually, they want to do it, and so it makes it a little bit easier to sell. From my perspective, I guess, but I don't. What advice do you give when someone totes the note? I know you want collateral from the buyer, and you want a lot of things. What do you have any kind of basic boilerplate advice you give now?
Well, again, it depends on the seller. So if the seller is depending on the sale of the business for part of his post-business lifestyle, or to support his post-business lifestyle, then I generally tell them, I generally recommend that they don't carry a note, or that if they do, that it be no more than 10 to 15% max. And the reason for that is because oftentimes they don't get paid. And the seller, if they're selling the business, it's one thing if they're carrying a 10 or 15% note in addition to an SBA loan that's being had, because then the lender is doing a lot of the due diligence on the seller. But if they, if they're going to carry a big note, 70%, 60%, then they need to do some type of a background check on the buyer. They need to basically hire somebody to do their due diligence for them, to do a background check, to do a credit check, to do an asset search and find out what kind of assets they have, what kind of collateral you can obtain. Because at the end of the day, the seller doesn't want to have to litigate to get paid. Litigation is very expensive. And the last thing you want to do is have to file a lawsuit to collect on a note. So, and if it's a small note, the other thing that I tell them is if they're retiring and they're willing to carry that 10 or 15% note, then it's like, hey, make sure that whatever you get when escrow closes is okay with you. If you never see another dime, know that that's a possibility. Are you okay with that? And if they are, then great. And if they're not, then they shouldn't be carrying a note, because there's just too many times when the buyers are going to default on it. And depending on the size, you can't litigate to collect a $50,000 note. It's going to cost you $150,000 or more in attorney's fees to go chase after a $50,000 note. It's not economically feasible. So
do you ever put in, like you said on that other loan that you had, one day late and, certain things happen. I suppose you could write your notes with certain things in mind. One day late, we get your car in your house. It's a default.
You can, but again, the only way to enforce it is through litigation. You can have whatever you want in the contract, but it's in the enforceability, right? You don't have a right as an individual to enforce your own agreements, right? You have to go get a court order, and that court order is going to cost you a lot of money. So SBA collateral, one of the things you brought up was the over collateralization. The good banks don't do that. They want enough collateral to cover the loan. They don't want more. And I had a company I sold. It was a small manufacturing company where there were actually 4 partners in this LLC. All of them put up property for collateral, and they all had equity in their property, and it was going to be over collateralized. The bank said, no, you guys figure out, with the collateral that you have, we'll use 3, you figure out which 3 we're going to use and tell us, but we don't want all of them. So I think it depends on your lender and on your bank, but a lot of the banks don't want to be, they want sufficient collateral to cover the note. Okay, cover the amount due. They don't want to be over collateralized.
Is there a reason for that, Tanya, that I'm missing?
I don't know. You'd have to go back and talk to the lender, to the lenders. I don't know.
It seems odd that they wouldn't take extra collateral. There must be a reason.
Well, I think it's like anything else where they have a certain ratio. Like I'm sure they're taking collateral up to maybe 150% of the loan or 120%, whatever their number is, but they don't want anything above that. And I don't know the answer to that, though. I have to check with the lender. But I do know that those are the banks that my clients prefer to work with, because You know, if a client owns, let's say, I remember this one client, he had like 5 rental properties. Well, he didn't want to put he didn't want liens on every one of his rental properties. There was no need for it. I mean, 2 of them were more than his primary residence, I think, plus one of the rental properties was more than sufficient to cover all the collateral needed for the note. And so by adding liens on the other properties, it would have prevented him from selling them when he wanted to,
Mhm.
or refinancing them if he wanted to, or whatever. So it's just not necessary for them to do that kind of extra work.
I've got a hard stop at 2 o'clock, guys. I'm gonna have to take off.
Yeah, I've got another meeting as well at 11. So anything else before we head off?
With the recent bank failings and bank closures, should we be looking more at the local and regional banks rather than to the major banks? Because a lot of them are failing.
Well, I mean, generally I try and work with the smaller local and regional banks anyways,
Right.
although just because they're easier to work with. I mean, the Bank of America and Wells Fargo and Chase and all of those are just a nightmare to work with because their underwriting cover is, you know, in 3 different states and different time zones and everything else. I mean, if you have a local bank where where your loan officer, your credit underwriter, all your decision makers are right in the same office, it
Area.
makes it much easier to go ahead and get loans through. So I
agree.
tend to work with the smaller ones anyways.